RBI's framework is very straightforward. If you start telling people that 9% guaranteed, then I will block you. You are not a bank to guarantee this. What RBI has done with this unsecured loan business is that basically if you lend to unsecured loans, the fear is that you will not be able to recover it. And because you're a highly leveraged entity, this could fall downstream on the people that you borrow money from. But what the P2P players is, give us 10,000 rupees and we'll only lend. Yeah, we'll find the right borrower, and if they return money, we'll give it to a different set of borrowers and all that stuff. That's not how it's supposed to be done. It should be like P2P.
Welcome to another episode of Cut the Noise. We're excited to have Deepak Shenoy join us as a guest for this session as we break down a very interesting and super relevant development from RBI. Deepak does not require an introduction, but just for the sake of getting formality out, Deepak is founder and CEO of Capital Mind. He's incredibly well regarded as a opinion mind on markets, on financial investing. He's a journalist. I can see a bunch of his books behind, and he's also runs a active investment strategy, advising clients on investing both in fixed income and equity, if I'm correct, Deepak, on both sides of the table.
We have PMS, so we actually manage both equity and debt.
Absolutely. Deepak is someone that we have wanted to have on this session or a podcast for a long period of time. We finally found the right topic and excited to have Deepak shooting this with us. Deepak, welcome to the session. It's been a very interesting week from all perspectives, between India hitting a $4 trillion GDP, losing the World Cup, to the developments at OpenAI and the RBI developments, right? I mean, packed 7 days. I've seen most of your tweets around almost all of these subjects. But I think the one that is probably most relevant and most topical to investors in India is the developments at RBI, right? And the action taken towards risk weights for unsecured personal loans. The point of the session is to try to explain what that means and the likely impact for investors. So let me begin by asking you something very simple. What is the consequence of risk weights in the definition of a RBI and bank? And how does increase of risk weight from 100% to 125% for such unsecured personal loans really move the needle for the markets?
Thanks, Nikhil. Firstly, thanks for that lovely introduction. Also, coming to RBI, I think what RBI has done with this unsecured loan business is that basically if you lend to unsecured loans, the fear is that you will not be able to recover it. And because you're a highly leveraged entity, this could fall downstream on the people that you borrow money from. And if the people you borrow money from have lent it to you thinking that you're relatively risk controlled, but you blow up, then they could blow up as well, because they're also leveraged entities like banks who lend to such NBFCs that might be lending to unsecured loans. And when it's a bank by itself, that bank itself can blow up if they're not able to manage recoveries. And in general, that is a long-standing fear. It comes down to, listen, we're seeing this grow a little too fast. I don't think this is a good thing. We don't want to stop it, but let's just make it more expensive. So when they increase the risk weights, RBI is essentially telling the world that, fine, you can continue to do this if you want, but I'm going to make it more expensive for you, because now you have to choose based on how much of your capital gets allocated to which kind of loan, whether you should choose a housing loan, a car loan, or a personal loan. And if you're choosing personal loans because the risk weight is low relatively, that means less of your capital is allocated to such loans, well, just make it that more of your capital starts getting allocated to the same rupee number that you lend, which means that you might find it more attractive to lend to other places where we believe the growth is not quite as fast. So housing loan growth is slowed down, vehicle loan growth is slowed down, but personal loan growth is 25% plus. Credit card growth is outstanding growth is more than 30%, year on year, and it's been 30% plus for the last 6 or 8 months. And this is why I think they've taken this action. What it essentially comes down to is that a bank or an NBFC can lend to many things. When it lends, it has to put a certain amount of capital of its own to block against losses. The idea is that if you deposit money in a bank, you don't care if the bank has lent to somebody who's defaulted. The defaults are supposed to be the bank's problem. The bank's problem is how much capital they have. That bank's capital that they have is roughly tends to be 15%, 16% of the loan book that they actually give out. But this 15% is calculated as a percentage of what is called risk-weighted assets. So you take the loan of 100 rupees, and sometimes that loan of 100 rupees will be counted as 40 rupees. It's got a 40% risk weight. Sometimes it's counted as 125 rupees, which is what they've changed to. They've changed what personal loans, unsecured personal loans are. From 100 rupees is weighted 100%. So that's 100 rupees means 100 rupees as a risk weight, or should you consider it 125 rupees, which is what RBI is telling us now. So if you have the same amount of capital, your adequacy ratio, which is the percentage of your capital to how much your risk-weighted assets are, has just come down because the denominator has increased. So effectively, you have the same capital, you're lending to the same amount of money, but that money is considered 125% of it now. And therefore, your risk capital adequacy ratios have come down. So what was maybe 20% will come down to 15% or 16%. And if it's 16%, you're too close to the number that RBI wants as a minimum, which is 15% as an NBFC, 12% or so as a bank. So you will effectively say, I need to either raise more capital, which is a good thing. That means you have more money in store in case defaults happen, or I will not lend to this place. I'll lend to other things, which is also okay by RBI because the growth in this has been quite strong.
I think there are two interesting things that you said, and if I could just separate them and I'll lead to the next question. One, there's change that RBI has made, but we must also interpret it as almost a yellow flag, right? In the process to say this sector, which is the personal loan, is growing faster than the regulator is comfortable with. And I, as a regulator, want to put a bit of speed bumps in that journey. So I'm going to take an action which will impact everyone in the process who's lending to slow down and maybe relook at their processes. So I think that's so more than the quantifiable impact, there's also qualitative messaging that RBI is giving. I think the second thing interesting that you said is a bank has to allocate capital against any kind of lending it does. So if it's lending against personal loans, it needs to keep now much more capital with it for the same loan provided. And hence it becomes more difficult to grow that loan book. Is that a fair summary, Deepak?
Yes, I think so. The concept of risk weights is very complicated because of how banks are.
Yeah.
But it's different for banks, it's different for NBFCs. The rules of what weighs how much is also different for banks and NBFCs. So, but essentially it means that, listen, if what RBI wants you to lend to, they will give a lower risk weight on. What they don't want you to lend to, they will increase the risk weight of. That's the pure summary of how they want to promote one versus the other. There are other mechanisms also. They can say you have to compulsorily do 40% of lending to this. You have to have 12% of your assets in something, 18% in government securities. So they impose different layers of regulatory baggage. And one of the layers of regulatory baggage is risk weights. This is worldwide considered the simplest and maybe the least intrusive way, because otherwise they'll force you, saying you cannot lend anymore. So
got it. Okay, understood. I wanted to now just, if you don't mind, break down the impacts to the various people in that chain, right? For example, yesterday, the day after the announcement, 17 November, we saw the bank Nifty correct by almost 2%. It came down by 2%, obviously as a result of this announcement. How are you seeing the impact in the short to medium term for bank stocks?
So there are lots of clarifications still needed. So let me just identify. The banks are not the problem. Typically, banks have most of Indian public sector banks actually have, or not public, private sector banks have a very large amount of CR. So they end up with 17, 18, 20%. I think HDFC Bank is 19%. So you're much higher than the 12%. So what if your CR comes down? You're still way above regulatory limits, so that's fine. All it will do is incremental growth may not come as fast, but I don't think with such a big buffer, it should not stop them from doing anything they want. Bajaj Finance is 20% plus. So a large NBFC like Bajaj Finance does not have a problem in CR. They've raised capital, so they will not have so much of a problem, even though their customer base is maybe 38% of them are unsecured personal loans. They may not feel the pinch so much because they have adequate regulatory capital. What it does for the markets is it's more a downstream approach. So there are a few clarifications. One is specifically RBI has said microfinance loans given by NBFCs is fine. That means they don't have this 125% risk weight, but they haven't said the same of microfinance loans by banks. So a bank giving a microfinance loan may be still considered applicable in the circular. Therefore, a lot of small finance banks whose primary customers are microfinance, they will see the risk rates balloon upwards, and many of them have maybe 17-18% CRs. 17-18% going down to 15 is a problem because the small finance banks need to keep a higher capital adequacy ratio. So those guys may get affected meaningfully once the RBI clarifies. RBI might come back and say, why was by mistake? Can we add MFIs back into that circular so that banks also don't have to place it? So till then, there is a bit of a confusion. The second area, the problem is mostly with unlisted or smaller NBFCs. They are the ones that don't have enough capital, perhaps, and they also have a fundamental problem in that most of the loans happen to be concentrated in such areas. Now, of course, L&T Finance also have such loans, but I think they also have a bunch of others. I'll give you an example of who gets impacted. One of the rules that have changed is also that when banks lend to NBFCs, the NBFC rating was determining how much the bank had to keep as risk-weighted capital. Because, of course, the NBFC itself will keep capital. So when a bank lends to NBFC, it has to put more of its capital down behind such a loan. A bank might go back and say, listen, I can't afford this at the original interest rates we talked about. Can we now increase the interest rate for you? Because I need to compensate for the fact that my capital is getting blocked in some way.
And this is irrespective of the lending profile of the NBFC, irrespective of the book compensation?
Irrespective. Unless the NBFC specifically what is called a priority sector.
Understood.
If it lends only to agriculture, it lends only to microfinance. These are priority sector NBFCs, they'll be fine. So it's the problem is with these NBFCs that are not that. So for instance, a Shriram Finance, which is an auto loan NBFC. Auto loans are not included in the circular because they're secured. But still the RBI said, when our Shriram Finance borrows from a bank, even though it's not a microfinance NBFC and it's an auto loan NBFC, it will effectively, it's a AAA, I think it's AA rated, Shriram Finance. So if it's AA rated, then the bank has to now put 55% as a risk weight. So which complicates matters for the bank, and therefore it will reduce the effective NIMs of a Shriram Finance in that context. But yeah, so that's the thing. But a lot of it is private, smaller sector, fintech NBFCs, people who are relatively new to the space. They may be in the process of raising capital, but not have to have raised. So now it becomes a problem because you're now going to your investors and saying, boss, I need more capital, but I'm going to become more capital inefficient in this way. This is a problem. But yeah, I think it's going to be very, very slow. It's not going to happen in any meaningfully fast fashion because, increasing interest rates takes a lot of time.
Yeah.
Nobody wants to increase interest rates, for instance. If you're issued a bond, the bond may take, 6 months to mature. So once it matures and the next funding cycle comes for it, that's when the new money will be borrowed, right? So you'll end up with that. So bank lending rates, we haven't seen any impact in that, by the way, right now. On the funding cost, zero, not even a little bit. So therefore, I think it's going to be very slow.
Yes. Deepak, in this slide, there's one more type of lender which I don't think has been talked about a lot, which is the P2P platforms, right? And in the last 24 months, they've achieved significant scale. All of it is unsecured lending to individuals, right? But they are not necessarily your typical NBFCs. They fall under a different regulation. Do you see this impact flowing into that, or because the source of money is individuals, it will have a very different it will play out very different?
I'm guaranteeing you this, within the next week or two, you will see much harsher regulations on P2P regulator. Guaranteed. This is like, not just that, it will make it difficult for P2P players to operate in this space without a significantly higher cost, which means that they will probably reduce the amount of loans you can take per customer, per borrower. They will create a network that says repeating loans across people is not acceptable. Right now, also a lot of people, P2P lenders, are actually talking about this whole concept as if it's a nice deposit scheme, 12% guaranteed, 9% guaranteed. This does not fit well with the RBI. RBI's framework is very straightforward. If you start telling people that 9% guaranteed, then I will block you. You are not a bank to guarantee this. It's a P2P operation. The risk is borne by the end user. If you are a well-funded entity that is somehow bearing this risk, you are effectively becoming a bank. I don't want you to become. I've never given you the regulatory license to become a bank. Therefore, I will regulate it so hard that you will, so they've done it in pieces. They will do it even more if they continue. So a P2P regulation will come in a big way. And I feel here, people are at severe risk because at this point, if you've invested in a P2P platform, you're probably okay making some returns and all that stuff, implicit guarantees by the... Tomorrow, when RBI comes down hard on this platform, the platform may no longer exist. Then what happens to your money? And maybe the money comes, maybe the money doesn't come. Maybe RBI forces people to get their money back. Hopefully, that's a good thing. But whatever it is, the signs are evident that if RBI thinks X is a problem, then Y will also be a problem if Y is equivalent to X, right? So you will find that this will get regulated in a more heavy-handed manner. And RBI is less beholden to P2P than it is to the banking system.
Sure, obviously.
So it will regulate much more harshly on a P2P player. And I believe at this point, a lot of P2P players simply have done the wrong kind of things. And offering guarantees, not showing customers like... So for instance, in a P2P network, you're supposed to be able to tell the customer this is who you've lent to. But what the P2P players is, give us 10,000 rupees and we'll only lend. Yeah, we'll find the right borrower, and if they return money, we'll give it to a different set of borrowers and all that stuff. That's not how it's supposed to be done. It should be like P2P. I should know who I'm lending to. If anything changes, you need to tell me, and I need to make that decision if that thing needs to change or not. RBI is going to make this a completely difficult proposition by saying, if you don't show people at every point in time who's borrowing, what is their credit score, and where they live and how the recovery process is and so on, then we won't allow you to operate this business. And now people will start getting random emails saying, because a lot of borrowers also, they're not of greatest credit, right? So they're just borrowing and lending off. So you suddenly find out your guys who have credit scores of say 400 or 500 which is very low, are getting your loans. What happens? And then the defaults, that changes the economic situation for P2P. I think P2P at this point, it's a worse idea than lending to NBFCs. And NBFCs also, I think lending is not so much a problem. I mean, if you're buying into an NBFC bond or anything like that, but you have to be very careful what kind of NBFC. Some of them will survive, some of them will not. So if you don't see their capital adequacy ratios today, and whatever it is today is going to go down tomorrow, because many of these P2P players, not P2P, so the NBFCs do have a portion of their book lent to personal loans, unsecured. So you're going to have that NBFC land in some kind of trouble. So if you forget buying their shares, but if you buy their bonds, you will still be in trouble, because even perceived notions in the financial industry can bring down a company. And if it's a small company, not very well capitalized, you will end up with trouble.
Yeah. No, thank you for touching on that, because ultimately, Grip as a platform offers corporate bonds, and a lot of corporate bonds you offer are from NBFCs. The good thing is that all of them are investment grade. Most of them are A and above. But I think, to your point, I think what we will try to make sure is that the information about capital adequacy becomes a very strong threshold for selection of corporate bonds on our platform, and also for investors to know what the capital adequacy ratio is before they invest. But Deepak, we've taken a lot of your time just to round up the session with this question on corporate bonds. Linking a few things together, you mentioned earlier that you do not expect bond yields to change much. You're not seeing cost of finance change much. This is something that will play out in the longer run. Do you have any other, most people were expecting bond yields to contract, right? Where we were in the interest rate cycle. This obviously is a very different development, may push up yields by a bit in the future. Any other advice that you're giving to bond investors at this point of time?
I think in general, you should expect bond spreads to widen. What I'm saying by that is the government bonds spreads bond yields may be X. Today, the difference between that and AAA is this much, AA is this much, A is this much. You expect a widening across the spectrum. We're going to say AAA getting 50 to 75 basis more than government. Right now, it's 10, 20 basis, that level. So you get when you get 50 basis higher on AAA and 150 higher on, say, AA and A, you're going to see that spreads widen across the board. Remember here, when interest rates go up or yields go up, the A guy will easily become BBB, simply because rates are up. I mean, it's not because of anything else. Because when rates go up, what happens is the structure of the business is this. I mean, a certain profit. That profit is based on input interest rate minus output interest rate minus cost. Output interest rate minus input. So that means what interest rate I earn, what interest rate I pay. Now, interest rate I pay is going up. Interest rate I earn, I don't know. It might not go up quite significantly, because if I increase it even more, I might end up with defaults. So your NIMs are already contracted. So now when your NIMs are contracted, your costs come into play. If your costs are not controlled, you will end up with very, very small return. When that return becomes small, some of these players don't have too much room. The credit cost, which is the cost of defaults. I would say when times of stress comes, if you're a retail investor, you are not capable of recovery. Therefore, move your investments to more secure investments. Take a lower interest rate if you have to, because you have to focus on the return of capital, not the return on capital. When the stress eases off, you can go back down the credit. It takes a lot of effort to understand who is not leveraged and who is leveraged. And this is a time of some stress, early days. You still have enough time, but you want to be careful about who you lend to. And if you understand the underlying risk, do you want to directly buy bonds or NBFCs?
Understood. No, I don't think we could end at a better note or a more appropriate note. Better may not be the right way, but definitely appropriate note. I think, Deepak, you'll be surprised how many times you have to tell investors to not go after the high returns that are offered on unrated instruments, right? That is the extreme of not knowing what you're investing in. It may be good, it may be bad, it may give you money back, but the reality is you have no transparency of what you're investing in. I think the point you're making is to say, even this environment, push yourself higher up the rating curve and make sure that you're being rewarded appropriately for it. Thank you so much, Deepak, for your time. You've been very generous. I look forward to doing a session with you in person and going deeper. But thank you for everyone who watches, and wait for the next episode of Continuous.
Yes, take care.
Investments in debt securities are subject to risks. Read all the offer-related documents carefully.